Hello and welcome back to the Credit Academy. My name is Michael, and on today's episode, we're going to dive a little bit more in depth on specifically credit scores and how they are calculated. There's so much that really kind of goes into our credit scores, and let's face it, if you haven't checked your credit report, that first time kind of checking it may be an overwhelming experience to say the least. So we're going to kind of dive on into each of the more specifics on the categories themselves when it comes to you and your credit report, and we'll dive into how those categories are weighed on your credit score. So let's dive on into it. So there's going to be 5 main categories when it comes to you and your credit scores, with the first category being your payment history. Now, the second category is going to be your accounts owned, where the third category is your length of credit history. Your fourth is going to be your new credit that you have. And then finally, your fifth is going to be your credit mix. Now, each of these categories will be weighed differently when it comes to you and your credit score. So let's dive on into the first category then. So discussing factor 1, payment history. Now, the key question a lot of lenders ask themselves when, looking at you for the potentiality of extending a new line of credit is this consumer willing to make their payments on time? This is going to be the most important category on your credit report when it comes to calculating both your FICO and Vantage scores. For your FICO score, it's going to be weighed at a total of 35% of your total overall score, whereas Vantage actually weighs this higher with 40%. So overall, your payment history shows your ability to not only make your payments consistently, but also on time, which are two of the most important factors, once again, that the lenders look for when considering you during their application process. But it isn't going to be all of your credit score into account when it comes to just them looking at this section. There are going to be the other sections, but the number one thing to focus on when you want to either build your credit or repair your credit is start by making those payments on time. So the second category I wanted to talk about was going to be the accounts owned category. Now, this is kind of where credit utilization can come into play. And honestly, the whole buy now, pay later may seem tempting when it comes to credit cards, but if you go too close to your credit limit, it can do you more harm than good. In reality, if you get too close to this credit limit, you can actually lower your credit score because you are being perceived as higher risk by the lenders. Overall, you just want to try to avoid as much as possible kind of these red flag scenarios when it comes to your credit report. Kind of other red flags, if you will, that can appear is hard inquiries. Now, this is another thing I've definitely tried to stress when it comes to you and you building credit, because it is such an important aspect that a lot of people don't consider. Anytime you apply for a brand new line of credit, it is going to run a hard inquiry check on your credit report. Even one of these can lower your score a few points, but if you do them in too quick of a succession, it can drastically lower your credit score. So we generally recommend waiting around 6 to 12 months before you apply for that brand new line of credit, just to double check and make sure that that previous hard inquiry fell off. So the next factor I want to talk about is length of credit history. Now, this one is pretty self-explanatory, but I do want to stress that this is an important aspect to your overall credit score. Now, your length of credit history takes into account the length of time that you've had open accounts on your credit lines. Now, essentially, the older any of your accounts are on your credit portfolio, the better this category is going to be. That's why we generally recommend never to close out old unused credit cards. If you discover a credit card with some cobwebs on it, definitely see if it's still readily kind of available to use. And you can start to begin using this card, keep it within that 1 to 7% utilization rate, because that card is going to be a lot older and is actually going to benefit your credit score by keeping it open. The minute you close that card, your credit score is going to drop. So according to creditkarma.com, if you have a kind of line of credit that's anywhere from 0 to 4 years, it is labeled as needs work, whereas 5 to 6 years is considered fair, and then 7 to 8 years is good, and then 9+ years is excellent. So you really want to shoot for those 9 years and up age for your lines of credit if you're able to. So the fourth category I want to talk about is going to be your new credit category. Now, generally what this takes into account is your total available credit across all of your credit portfolio. So in general, the more lines of credit you have and the more just readily available credit in general you have, the better this category is going to be. Now, like I said previously, it is possible that having, a couple hard inquiries on your credit report can actually lower your credit score, as well as if you have a lot of brand new lines of credit on your credit report, it can lower your length of credit history, which could also lower your score. So there is a lot of give and take, especially when it comes with this category. So you don't want to go too overboard with, applying for these brand new lines of credit, but it is important to consider that your total available credit is going to be factored into this category. In general, the one rule I would kind of say to live by when it comes to you and your credit is really only apply for credit if you need it. Now, you're not going to get an 800 credit score overnight. A lot of people are going to be working to build this up over 20 to 30 years. So start small, start by just getting that, first credit card, or even if you can't get, a credit card immediately, start off with a secured card or a credit builder loan and slowly work your way up to, getting maybe 3 to 5 unsecured credit cards, maybe mix a personal loan or an auto loan or even a mortgage in there as well. And then you'll have kind of a very good credit mix. And that leads me into the fifth and final category I wanted to talk to you guys about, which is going to be the credit mix category. Now, this section, like the name kind of implies, is going to factor in all of the different types of credit that you have. Lenders, when they generally see you applying for newer lines of credit and when it comes to calculating your credit score, want to see a healthy and diverse portfolio. They want to see that you can have more than just strictly credit cards or strictly, one mortgage or something like that. They want to be able to see, in general, that you're able to manage different types of credit lines. So the ideal credit mix lies between both revolving credit and installment credit. Now, what do both of those terms mean? Well, revolving credit is going to be kind of like the traditional credit card, aka, the balance can revolve into the next or following month. Now, installment credit is going to be kind of the more traditional loans, like anything like a personal loan, student loans, mortgages, things like that. Now, while it may be tempting to kind of prioritize and focus on one type of credit, you never want to put all of your eggs in one basket, as the saying goes. Once again, you want to try to diverse and have as many different types of credit that you can. Now, there is one more category I want to talk about. Generally, this category isn't going to factor into your score, but it will come into play a little bit further on when we start discussing disputes. Now, this category is going to be your personal information section, and this is generally going to be the first category on your credit report at the very, very top of it. And with this category, it's going to have things like your name listed, as well as any previous addresses you've had listed there, kind of tied to previous accounts and things like that. Now, in general, what we would recommend is you only have one name and one address listed there. Now, there is going to be, for a lot of people, multiple names, especially if you have, say, like a maiden name or a previous legal name listed. Things like that you can actually have requested to be removed, as well as when it comes to your address, if you have a recent address and you haven't been living there for at least 6 months, you want to keep the previous address that you've had as well. But if you've been living at that new address for longer than 6 months, try to remove all of those other addresses. The reason why I say you should only have one name and one address is it can drastically kind of increase your chances, if you will, of a successful dispute in the future. Now, I don't want to dive too much into this. This is kind of a later topic for the Credit Academy, but I do want to say this is an important section of your credit report. So now I want to discuss some of the tips you can use to help maintain or keep a healthy credit score. Now, tip number 1 I want to discuss is keeping your credit utilization below 30%. Now, I briefly kind of talked about this, but in general, you want to make sure you aren't going to be higher risk when it comes to getting a little too close to your credit limit. Now, it is going to be around 30%. This kind of kicks into effect, but we recommend kind of keeping a buffer, if you will, between 30% and where you should be, which is around 10%. We recommend anywhere from 1 to 10%, or if you're even willing to, 1 and 7%, to really, once again, kind of give yourself a buffer between you and that higher risk section of 30% and over. So tip number 2 is going to be keep your accounts open. Now, length of credit history here is very important, and I did briefly touch on this as well, but it is so important that you don't close out those old unused cards, or those loans or mortgages. You don't pay those off too early, because the longer those are on your credit report, the better your score is going to be. The third tip I wanted to discuss is going to be set up autopay if available to you. This is such a powerful tool and allows you to never miss a late payment as long as you have the balance readily available in your banking account or credit card account. It is such a vital aspect to your credit score. Remember, that payment history section is going to be worth anywhere from 35 to 40% depending whether you're using a FICO or Vantage scoring model. So make sure that you are making those payments on time. And if autopay isn't available, set up some reminders for yourself. It is such an important aspect to your score. Once again, I cannot stress that enough. So like always, the more you know, the better off you'll be. Credit is a very confusing topic, but taking the steps necessary to really educate yourself, you can turn yourself into your own credit kind of professional. And at the end of the day, it opens the door to a lot of financial freedoms and goals that you could achieve a lot earlier than you would otherwise. So thank you guys so much for watching. Be sure to like, comment, and subscribe if you guys enjoyed the video. Also, be sure to give us a text or sign up for our free newsletter, or visit the link down in the bio to actually get a free 15-minute consultation. Also, make sure to check out our other social media channels in addition to that. My name is Michael. Thank you guys so much for checking out the Credit Academy, and we hope to see you guys in the next one.